Welcome to the daily update. This is being prepared Wednesday, March 30th, where we'll look at the action in the market today and then see how things look for Thursday, March 31st. And right off the bat, I want to apologize to the folks on Rumble. I had a really difficult time being able to upload yesterday's videos. I tried numerous times, and then much later than I usually like to post them, it finally took and made those videos available. I hope that's just a short-term problem that we don't run into on a consistent basis. Well, what happened on Wednesday? We had a bit of a down day, and it probably should not be real surprising. We've been going up pretty far, pretty fast. We were having a lot of people that were skeptical of this climb. Well, just about the time they might have been saying, maybe this is for real, we stalled out. Now, things are still positive right now, but where do we go from here? Kind of a thing. Are we just going to work off some of our extreme positive readings before we get set to go higher? You can make a good case for that. If we see prices continue to decline, is volume going to pick up? Are we going to see some real conviction behind the selling? Okay, you can make a case for that. Or are we going to bounce sideways for a little bit? Okay, all three of those cases are probable. We just have to be ready no matter what scenario actually plays out. So let's go back and look at Wednesday's session. We did gap lower at the open, and it gapped right at the daily pivot. And remember, the cool thing about pivot points is they're calculated before the market even opens. They're on the chart, so we can see them, and it just amazes me how important these levels can be. As we went along, prices bounced between the daily pivot that acted as resistance, and then we dropped down to S1 that acted as support. Well, then it looked like things might be turning a little bit more negative. We actually broke below S1, and there's even a support level that we broke through briefly, but there was some late day buying that came back in and brought prices all the way back to S1. So yeah, we had a down day, but to see that late day buying could be taken as positive. We ended up finishing down 0.63% for the day. Volume decreased, so we had a down day with a decrease in volume, but overall, we've been dealing with a below average volume environment. So again, just lower volume than already low volume. The technicals continue to be positive. We're still dealing with earnings season, kind of on a case-by-case basis. Inflation and interest rates continue to be at the domination of everybody's thoughts. And of course, the geopolitical concerns, specifically Russia, Ukraine, things are looking not quite as positive now as they were yesterday, but this can change all the time. And then, of course, a lot of people are really focused on the inverted yield curves, and I'll address that later on in the video. The technicals are still positive, and they still continue to improve. Now, some of them are pulling back a little bit, especially our short-term indicators, which is to be expected because they're giving us some extreme readings. They still may have more room to pull back. One thing that is kind of positive is when we broke through that double top, that short-term double top, we came right down to that, and that's where we closed on Wednesday. So what had been resistance, at least in the short term, is now providing support. And of course, all the different geopolitical events that I keep talking about over and over. The economic report that came out, the one that was kind of getting the most focus, is that GDP was revised down just a little bit, not much. Didn't really move the markets because this is one of the revision reports. Since GDP comes out every quarter, they also like to send out different reports every month. There's the first revision, second revision, then you get the GDP, then you have the final version, blah, blah, blah. Goes all over the place with the GDP because it's such a critical thing. We're still overvalued when you're looking at the S&P itself. We're more fairly valued when you compare it to bonds. The trend is positive and possibly strengthening, and I'll show you that in the ADX chart. Because we had the down day, our bias has switched more over to negative, but overall, our momentum over the last number of days continues to be positive. So let's go through the day's session. First was sentiment. We're just a little bit over into positive territory, but we're pretty much neutral as far as the overall fear and greed index is concerned. And here is the historical chart where we came up out of that nice little base. And this indicator ended up being very helpful in showing us that, okay, pessimism is so far down that a bounce here would not be a surprise. And that's really what happened. The VIX turned up just a little bit on Wednesday because we had a down day, but we're still below 20. And that's usually when we're at the upper end of not really fearful right now. The VIX of the VIX also came up just a little bit on a closing basis and is more into a sideways pattern on the daily chart. Ulcer index declining overall. Different sectors. The sector that got hit the hardest was discretionary. They're still not doing very well overall, but they've been doing well lately. Well, they got smacked a little bit on Wednesday. There were two sectors that were up, which are the ones that have been doing pretty good lately, utilities and the energy sector. And here's just going back to the high. Energy is still in first place. We have communication in last place with discretionary not far behind right here. Then looking at just the tech sector itself, because I keep an eye on that just to give us this growth value battle as it's going back and forth. We did decline 1 1/3%, but we're still above the moving average. As far as inflation, the CRB was up 2 1/4%. So this really strong uptrend is still intact. Technical alerts, they were mostly negative, and they had to do with price levels because the NASDAQ, it dropped below 14.6, then 14.5. The S&P dropped below 46. We closed just above 4,600, and then the NASDAQ also fell below 14.4 at one point, and then oil went back up. It was able to get back above 105. Intraday chart, here way on the right side, here's the gap lower, and this is the pivot, this solid line right here that's calculated even before the market opens. In fact, you can see the pivots for Thursday already calculated here. But we danced kind of right along the pivot line. That means we were pretty neutral overall, a little bit above, a little bit below. That's kind of the tipping point on a daily basis. Well, we broke down below that, almost made it down to S1, but then kind of just danced around between S1 and the pivot. Then it looked like, oh boy, here we go. We're breaking down late in the day. Well, that was pretty negative, and we broke through this previous, which had been resistance, is now acting as support. We didn't get too far below that, but then this is the late day buying that we saw coming back in, and that got us back up to R1. So the late day action is more positive, even though we had a down day. Here's what it looks like on a daily chart, where we were able to close just above this resistance level right here. Well, we're just about at the top of the short-term resistance level, which now might be acting as support. We are currently down 4.05% from the all-time high. Growth saw a decline as value saw an increase. Comparing the two charts, growth has been in a downtrend overall. Didn't know why that's on there. And has been able to reclaim the 50-period moving average, but did have a decline on Wednesday. Here's the inverse of that. Value has really been advancing, but has since been falling back. NASDAQ 100 against the S&P. It underperformed the S&P on Wednesday, but has been trying to make a comeback lately after being in a pretty strong downtrend. Here's the index for peer value, and it was down a little more than 1/4%. And then I'll try to have the right chart this time. Yeah, here we have the growth chart where it was down more. It was down 1.79%. So value held up better than growth on Wednesday, at least according to this index. Then to compare the two. So when we see this chart going higher, that means growth is winning out. When we see this really declining, that means value is winning. Well, we've been able to bounce up from this low and doing pretty good, but we did fall back a little on Wednesday, 0.84%. As far as our trend, this is what I'm talking about. We're seeing the ADX turning up and starting to cross the moving average. Even though we saw a little bit of a decline in buying power, we're seeing a flat reading right now with the selling pressure. So that's helping the ADX measure between these two lines, and it's starting to turn up overall. If this does continue to go up, and as long as the green line is on top, that would be a positive trend. Our Arun fell just a little bit, but it still is pretty near the top, showing that buyers are in control. Selling is still falling off, and well, we're kind of flat pretty much with our oscillator. Then there was a little bit of a change with decision point. They're in the short term, they're positive. Intermediate term, they went from neutral to positive, but they're still, as far as the PMO signals, they're still negative. Long term, they continue to be positive. Looking at breadth, with a down day, you can see that there was a little bit of a decline, both based on price and volume. With volume, we've come right up to this moving average and we're going back down. We'll have to see, is this going to act as some kind of resistance? It hasn't really done that recently, but we're in a highly technical analysis market right now. So this might be something that folks pick up on and use as a sell signal. The advanced decline ratio, after going extreme positive, has now come back down slightly with the declining day. New highs, new lows continue to be in an uptrend, but rolled over slightly, at least with this moving average, but continue to go higher with our 10-day moving average. The accumulation distribution, which I pointed out yesterday, might be getting a little far away from this moving average. Well, it turned down ever so slightly. It looks flat, but it's actually come a little bit closer to the moving average now. Short term, we're still well above the 20. With the 20-period moving average, we're working off an extreme positive reading. We turned down a little bit with the 50-period moving average, and we declined ever so slightly with the 200-day moving average. We're still well above all of our moving averages in the spaghetti tree. MACD continues to advance, even though the histogram declined slightly on Wednesday. STO continues to advance based on price and volume. And I'm trying to hit the right button. And then this is another kind of a concern. The McClellan oscillator declined a little bit, but is still in pretty extreme positive territory. We could still go back up from here, but we might see this work down from such an extreme positive reading. Williams percent R, peg near the top and starting to decline. I'm sorry, this is the Stochk RSI. Well, I could say the same thing for both of these charts. Williams percent R also extreme positive and turning down slightly. Force index declined a little bit, but is still pretty positive. Intermediate term, well above our 50-period moving average. PMO continues to advance, also based on price and volume. Then the PMOs that are actually rising, this was looking a little toppy too. Well, it turned down slightly on Wednesday. This is also looking toppy with the number of buy signals in the PMO. It's rolling over slightly, and those that are above zero, it's continuing to advance. The BPI, there's a really small little bar right there. We saw a little tiny bit of a decline, but this is also an extreme positive territory. And here's just the longer term view of that chart. The rainbow, we're still above all the moving averages in the rainbow, and the longer we can do that, the more these will turn back up. Stochastics, also something else giving us some concern. Really pegged and starting to roll over in short term, trying to roll over a bit intermediate term, and just rolled over ever so slightly in extreme positive territory with the full stochastics. Then our rate of change, the reason I bring this up is we were showing an extreme positive reading. We worked some of that off on Wednesday, but we're still in extreme positive territory. Then looking back 20 days, also got up to an extreme reading and working some of that off. The summation index continues to advance based on price and volume because the McClellan oscillator is still positive. All of our momentum oscillators are still positive. Vortex still advancing slightly with the buying power, declining slightly with the selling pressure. So that's still looking positive. The RSI turned down a little bit, but is still above 50. CCI 14 period coming off an extreme positive reading. CCI 20 also rolling over, but has not dropped below the 100 line yet. The standard deviation coming back down, looking a little bit more normal. I'm probably, unless we have a big day of movement, I'm probably going to drop this chart for a little while until it tells us something. The Chaikin oscillator also coming off of an extreme positive reading. Chaikin money flow declined a little bit, but is still positive overall. Ultimate oscillator coming down off of an extreme positive reading. So you can see, especially on a short-term basis, and even to a degree on an intermediate term basis, we have been overbought, and the market is now starting to deal with that. That's kind of the scenario I'm going with, unless we really see some heavy-duty selling that changes the whole dynamic of the market. But right now, the positive side is still holding up. With our different trading systems, we have the Elder system. With the decline, it's now gone back to neutral. Then looking at the SPY, the ETF on the S&P 500, it's also dropped back to neutral. The SAR continues to be positive. It's going to take a lot more than what we saw to turn this back negative. Our different charts, Heiken Ashi still is looking positive overall. Arcegi still looking positive. Renko still looking positive. Three-line break still looking positive. Equivolume, we see another red candle here, but there's still a lot more green than red lately. No signal changes on the point and figure chart. We had a new one generated after Tuesday, and the current signal is still saying a double top breakout. Long term, we are above the moving average. So that helps our long-term trend. Here's the logarithmic chart as well. Big stocks, they were down over 1%. They've been bouncing back, but had a little bit of a decline right at about the 200-day moving average. Special K still turning up overall. And then here's the longer version of that chart. Moving averages looking pretty toppy with our 50-period moving average. So we're declining there. Had a little bit of a downturn with the 150 and the 200 moving averages. Looking at the broad market, here is the S&P looking pretty healthy overall, at least right now. Mid caps also fell back. Small caps also fell back. The Dow Jones Composite. This is the Dow, the trannies, and the utilities all taken together. We're down 0.28%, but are still in an overall uptrend with a recent golden cross. FANG stocks down 1.33% after having a pretty nice run as of late. The ARK Fund was down 3.8% on Wednesday. The Dow is still above its 200-day moving average, even with the decline. It was only down 0.19%. So if we can continue to stay above this 200-day moving average, that will be much more positive. The diamonds back to neutral with the slight down day. Small caps, after breaking above the 200-day moving average, have now dropped back below the 200 moving average. We're right above the 200-period moving average with the mid caps. The NASDAQ never did get up to its 200-day moving average, but saw 1.21% decline on Wednesday. NASDAQ 100, after getting slightly above the 200-day moving average, has now fallen back below it slightly. Then looking at the VIXN, with the decline, we saw a little bit of an advance. The QQQs have gone back to neutral right now. Then the NYSE composite, it's still above its 200-day moving average. It was down 0.48% and still looking okay overall. Then looking at the NASDAQ 100, it actually outperformed, the S&P 100, it outperformed the rest of the S&P, and it was actually up slightly. The Wilshire, still above the 200-day moving average, even with the decline. Internationally, still showing some improvement across the board. All stocks, after just slightly breaking above the 200-day moving average, has now declined just below it. Then looking at our other index with non-US stocks, they were actually up 2.21%. So, but this is still negative overall. Broad market with the dollar, it got spanked a little bit, down 0.57%, but is still in an overall uptrend. Here's the weekly chart thus far, also showing an uptrend. And oil, it actually bounced up and closed at 107.82. Gold is up 1%, but is it a fake out or a breakout? That's the thing. Here's the longer term view of the ETF, where we bounced off of the 50-period moving average. Can that continue is now the question. And here's the longer term view of the ETF. Silver bounced up off the 200-day moving average. It was up not as much, but still above the longer term moving average. And here's a longer term view of this ETF. Bitcoin still kind of floundering around into the mid to upper 40s right now. As far as bonds, and this is where I'm going to take a little extra time and talk more about the yield curve until this becomes non-news, and that'll happen here pretty soon. Here is the 10 to the 2 spread. We have not inverted yet, at least on a closing basis. Here is the 10 to the 5 yield curve. We have gone inverted. We've been inverted now for a few days. Here is the 30-year to the 5. It has not gone inverted yet. And then this is the one that a lot of people use. It's the 10-year to the 3-month, and this is still going in the opposite direction, which is why we're getting real mixed signals and why there's a lot of debate about this. Then I wanted to bring up the 30-year yield because we're getting back down to the 50% retracement on the fib chart, which is now acting as support. Yields saw a decline. See how these are all bunching up right here? That's part of the problem that we're having. And we're seeing the red and the green actually flip-flop in places. Internationally, we're still seeing a pretty strong increase in yields across the world. Bonds actually bounced up a little bit, but we're getting down here to what could be pretty significant support, according to this index. Corporate bonds bounced up a little bit on Wednesday, and the current yield that I was able to get is 3.47%. Junk bonds declined with the market in an overall downtrend, trying to come back up to the 50-period moving average, and is so far breaking down a little bit below that. Relative studies. Here is gold and the S&P. We're still continuing, even though we bounced a little bit, we are below this moving average. But gold had an up day, the S&P had a down day, so this ratio improved slightly. But we have to look at the overall trend. After it looked like it was breaking out, currently it still looks like it's breaking down. Then here's energy against the S&P. With the up day in energy, energy is now outperforming the S&P, which is really no surprise with the rise in oil prices. Here's growth against bonds. We saw a little bit of a decline, but growth lately has been trying to make a comeback and is still above the moving average. Then looking at the tech sector against the S&P, we're coming up to the moving average, and we actually bounced down from that slightly. Looking at tech against the 10-year, it actually advanced a little bit because we saw a decrease in interest rates on Wednesday. And then looking at the 10-year against tech, where we're seeing interest rates are still winning out in the trend, even though tech is really trying hard to change that. Then comparing discretionary with staples, we saw a little bit of a decline in discretionary, still in an overall downtrend, but discretionary has been trying to make a comeback. Then this is a chart. I showed this in yesterday's video, and I have a shorter term version of this. I actually went through and drew some lines. This is hardly scientific. I just went through and eyeballed when were there spikes in the ratio between the staples, the things that you have to have, and the S&P. And you'll notice a lot of times this marked either a short-term to intermediate to even long-term bottom, sometimes with the S&P 500. So if you look at some of these lines, and they're not, again, I just eyeballed this, where when we see a spike between this ratio, a lot of times that will signal a low in the S&P. And if you want to, you can pause it and look at this, and you can even find some areas where I missed. But this is the one we're coming out of right now, where this was when we hit that bottom that we've been coming up out of. Well, the XLP ratio to the S&P, it spiked up and has now been falling back. And then this is just a shorter term look at that same chart, because this is a hard one to use in real time, because we don't really know. It might look like a spike, but then it ends up spiking even higher, and then it drops back down. Oh, here we go. We kind of have to use this in context with other things. You try not to use this as a standalone indicator, because it only works in hindsight. Sure, we can go back here and look and say, yeah, I should have done this, should have done that, blah, blah, blah. But it might be well after the fact before you even realize that things are changing. And so what I've tried to do is plot a moving average on here. That might guide us a little bit. And I might even include a pared down chart here that shows us an even shorter time period, just so we can be aware of this, because the lag time between when this actually happens and how it can help us can sometimes be significant. Then comparing the S&P with the 10-year yield, well, the S&P actually performed because we saw a decrease in interest rates. And then looking at the low volatility stocks, they advanced 1/3%. They held up better on Wednesday, even with the decline. And then this is comparing the two with the low volatility stocks ratio against the SPY. It advanced almost 1% and has been falling back, but is still performing fairly well. Then looking at the CRB, this is another newer one that I'm using, and I might want to stick this closer to the beginning of the video where I look at the CRB index, but this just measures the CRB against the S&P 500, where it was up on Wednesday because we saw the CRB advance and the S&P decline, and the CRB has been really outperforming the S&P 500. And then this is just an inverse of that same chart, showing that the S&P has been underperforming the CRB index. So what are we looking for on Thursday? The markets are still in this intermediate term range. We closed at that short-term double top, which now could be acting as support. Now, then we might blow through that. That may only be very short-term support, or it might end up being somewhat significant. There's still the battle between value and growth. There's still the yield curve concerns that we're dealing with. On Thursday, we have personal income and spending coming out. We have PCE prices coming out. And then every week we have the initial and continuing jobless claims coming out, as well as the Chicago PMI. And sometimes the market can latch on to these things and use it as an excuse for going higher or lower. And then, of course, the continuation of the same geopolitical events. My understanding is China's still in their lockdown phases. And again, what's that going to do to the economy? What's that going to do to the supply chain issues that we're already facing? So what are our scenarios? I've changed it up a little bit. I have 4 negative scenarios just to kind of consider right now. Number one, which is kind of where I'm at right now with this, is that we are short-term overbought and hitting resistance. And so we're pulling back off of that. So we're going lower because we've climbed too far too fast. Okay, to me, that makes sense at this point. Also, rising interest rates and yield curve concerns. If interest rate, now they were down on Wednesday. So if they really start screaming higher, that might bleed over into the stock market. That could force stock prices to go lower. Also, this idea that the disbelief that we're even bouncing up out of this when everybody was negative, turning into belief, that could end up backfiring on a lot of investors. Now that they're seeing that the Dow crossed its 200-day moving average, they're looking to get into the market, and they might be coming late to the party, at least in the short term. And then another thing that I just added is, will sentiment turn more negative? Okay, we had a bit of a down day on Wednesday. Are we going to follow that through with another down day on Thursday? And are we going to start seeing good news as bad news and bad news as bad news? Okay, we kind of have to wait to see what the overall mood of the market is at that point. Right now, it's still staying a bit more positive, but could it turn more negative? The up scenario is what we're seeing played out right now, is that we're seeing some strength after building that base. Our oscillators are positive. The moving averages are acting as either support or resistance, and we were able to close at the short-term double top. And then this idea that a lot of people didn't believe this could go any higher, well, we might go back more into disbelief if we have a couple of down days, and then the market gets set to go even higher. And then the third scenario, which again is looking least likely at this point, is that we get into a neutral pattern where price movement really slows down, which ends up working into a trendless environment. Right now, we're seeing more wild swings. Now, Wednesday was not a wild day, but to see a 1, 2, 3% up or down day is still not out of the norm right now. So what's our conclusion? Overall, the S&P is positive and could be breaking out of a range. That's still the same. We're positive in the short term. We're still at some overbought levels, and we still have some resistance levels above where we're at. Intermediate term, we're positive. Our oscillators are positive. Moving averages are providing either support or resistance. And then we continue to be above the 200-day moving average with the S&P. And the longer that happens, the more positive that becomes. So thank you. Have a very good Thursday. And I will prepare my next video after the market closes.